thank you very much. This being the last session, we hope that will keep you interested. And, and I want to thank our panelists because two of them actually came in from overseas. So I want to particularly thank Qian, who is with head of private equity for Schroders, who flew in from Shanghai. And of course, Avery from AB CarVal Investors, which is part of the AllianceBernstein Group, who flew in from Singapore. So special thanks to the two of you who came in specially for this. The title of this session is Alternative Investment Opportunities. Typically, at ASIFMA, we focus on the capital markets, the public markets, so it's equity and fixed income. And the reason I think I picked alternative investment is because I'm hearing more and more from my members. As you know, we have 42 asset manager members at ASIFMA. And increasingly, over the past few years, I'm hearing more that they're doing more private equity or other types of alternative investments. And that's why I think this panel would be of some interest to people in the audience, as this is a growing area. Now, when we talk about alternative investments, it usually means, private equity, real estate, infrastructure investments, and more recently, private credit. And so you're hearing the term private credit mentioned quite often. So I like to start maybe with private equity, which is probably the number one asset class within the alternative investments area. According to a report by BDA Partners, published this March, the total investment value in China's PE market, private equity, which includes private equity, venture capital, as well as early stage investment, in 2022 alone was 908 billion or 126 million US dollars. Now, that actually represents a drop of about 30, depending on where your source of the information is, a drop of 30 to 80% from the previous year. So private equity, I think, has encountered some issues over the last few years, particularly, I think, with changes in certain policy towards certain sectors, and I think you know which sectors I'm talking about. So I think with that in mind, with this potential, large drop in private equity transactions or investments over the past couple of years, I thought it's time to sort of get an insider view, somebody on the ground. So I'm going to invite Qian from Schroders, head of private equity in China, to maybe just share his views as to whether or not this is still an asset class that is worth considering, particularly for foreign investors. So Qian, turn it over to you.
Yeah, so thank you, Eugenie. So my name is Qian. I'm heading the private equity practice of Schroders Capital in China. So a little bit about our organization. So we have 3 layers. So the first layer is actually the Schroders PLC, which is listed in UK. The second layer is our Schroders Capital, which is the private asset arm of the Schroders Group. The third layer is the 4 BUs under Schroders Capital, which are the PEs and the private debt and the infrastructures and the real estate. So high-level summary about our organizations. So back to the question which Eugenie raised, I came across this question pretty frequently recently. So let me explain. So I would like to start with the high levels, so GDP growth. So last year, China recorded a 3% GDP growth. That's the second lowest GDP growth in the past 10 years. However, that 3% was achieved during lockdown. And we also need to keep in mind that China has 18 trillion GDP size. So the absolute number increase is roughly 600 billion US dollars, which is very, very large. So the growth side, China is still very good. And not to mention in Q1, it rebounded back to 4.5%. So that's very important for all the investment classes. The second point is about this diversification, because diversification benefits everybody. So China has roughly 1% inflation. China's interest rate is actually decreasing, which is in a totally different point in the economic circles compared with the Western countries. And we believe China has such a large size, and it's the best possible risk diversification for international investors who want to have a balanced allocation. So that's the diversification parts. Now we can talk about the private equity industry overall. So as you might know that in the past 3 years, on average, globally, there's roughly $900 billion raised for the PE industries, in which 1/3 of them, $300 billion are raised for China. It composes of two parts, the US dollar part and the renminbi part. And the US dollar part is roughly 10% of it. So it's not that significant in terms of the allocations. And it will be very interesting to start if you look back 12 years. So in year 2010, in that year, US dollar fundraising is roughly $22 billion. Renminbi fundraising is around $18 billion equivalent. Since then, the US dollar fundraising has a little bit like up and downs, but the renminbi fundraising has been very, very stable. You look at the numbers of 2022, it's actually roughly 270 or 279 billion US dollar equivalent renminbi are raised for China. So that's 15 times increase. So this shows that China is the second largest PE market in the world. And that size didn't change too much if you're considering the global fluctuation in terms of fundraising in 2022. So the big picture-wise, the second largest market is still very positive and still grow. We can also talk to something in details. I can use an examples of the renminbi secondaries. So structurally, when you look at typical renminbi fund, you will find out actually more than 70% of the LPs are not necessarily institutions. While when you look at the typical US dollar fund in China, you will find out the institutional investors account for more than 90%. So what does that mean? That means the renminbi LPs are not overly stable. In many cases, they are not long-term investors. In many cases, they cannot own the capital call. So for the renminbi secondary deals, which we are looking at, typically you can ask for between 30 to 40% discount, which translated to 1.5x to 1.6x on day one. It's not that bad, right? You get it on day one. So I just use this as an example to show that renminbi secondary deals, for example, is a very attractive field overall. Back to you.
Thank you. Well, don't forget, please feel free to use Slido or scan the code if you have questions for our audience. Thank you for that introduction to the private equity world. So there are plenty of opportunity given the fact that China is still the second largest private equity market, notwithstanding some of these sudden changes in policy. And maybe I'll come back to you if we have time on that. But I want to turn to this other area, which is private credit, which I've been hearing a lot about. So over the past decade, we've seen sort of unprecedented growth in the private credit sector. And private sector, generally means that this is an alternative form of loans or debt financing, and usually typically to small and mid-sized enterprise without any investment, credit rating. And the providers of this financing are really sort of more like private companies, private lenders, rather than the public markets or bond issuances. So with that, I think I'd like to have Charles Chang, who is with S&P Global. He's the country lead for Greater China Corporates, and Charles is going to talk to us a little bit about the China private credit market. I think, again, just throwing out some statistics, it's grown incredibly big worldwide, private credit, and it's certainly not surprising that it's growing in Asia. But for this purposes of this conference, I'd like to sort of focus on sort of China. What are the opportunities in the private credit space? So Charles, please.
Thank you. So as you mentioned, and for everyone here, private credit is a rather loose term. And as you know, it kind of includes everything that is not in the public markets on the credit side, which is quite a big range of activities. So just to start off, private credit recently has gained quite a bit of attention, quite a bit of interest from investors globally in the US as well as in Asia and Europe. So as a firm, S&P credit ratings, we are looking into and doing work on the progression and developments in this sector. Our bread and butter is credit risk, and this is certainly an area with a meaningful amount of work to be done. So for our part, just to kind of lay out the landscape, so private credit in Asia is relatively new. Historically, it's been left with a select number of firms that focus on that. And it ranges anywhere from distressed credit, special situations, to trade financing, and so forth. So with China, there's obviously a historical and ongoing concern about the legal infrastructure, whether you can pursue this kind of an investment in China, given the enforceability of contracts, given perhaps some questions about the legal issues in the country. So I will leave Avery to talk more about that. He's the expert here. But I would just say that from what we've seen, the legal infrastructure in China has been functioning. It has improved over the last 2 decades or so. And the courts work. And they're being put to test right now because, as you know, there have been a high number of defaults, especially in the real estate sector. So the courts previously didn't get too much experience on that. They are getting the experience as we speak, and cases are being built. So in this context, there is a kind of a basic set of requirements for this type of investment. But one thing that I think investors, and as well as for us to think about, is in a market such as this, where the public markets don't really test the price and test the firms, there is perhaps an even weaker level of transparency. So transparency would be the key focus, I think, for investors as well as for us, whether you're getting the right information, whether you're getting it in time, whether you are getting good information. And all of that, I think, is something that for professionals who've been focusing on this, they have found ways to deal with that. For the market overall, this is something, obviously, that all of us will have to think about. And that has to do with a number of features in this market. For example, the importance of the alignment of interests between the majority shareholder and the lender. And for example, the structural features that are built into these deals. As you may know, these deals are non-standard. There's not a template per se for all of these deals to look alike. So in many cases, these are bespoke and built according to the nature of the firm, nature of the industry, and nature of the assets. So these are things, I think, for us to think about and work on as this market continues to gain interest. So on China itself, so one thing I just want to leave everybody here with is this thought, which is there is quite a bit of disagreement in the market as to where China is right now. In the beginning of the year, there was a lot of hope and optimism that China's recovery is going to be strong enough to withstand the global recession and perhaps reverse it. That is no longer the expectation, and therefore there are some people who are disappointed. For our part, our econ team projects the growth for this year to be 5.2%, and that's revised down from a 5.5%. Okay, now 5.2% is still a recovery, so the recovery will continue. And a couple of data points to think about here is, for example, in the latest reporting, exports dropped by something like 7%. If you look at discretionary consumption compared to 2019, it's about 20% higher. If you look at Macau, the gaming revenues have more than doubled so far this year. And mobility has seen a real strong rebound so far this year. But what you're seeing in a lot of commentators and also in the media is that China is slowing down and there are a lot of problems. So this is a time, I think, where you need real analytical firepower to kind of decipher what's actually happening. And the truth is, in terms of where China is right now, it is recovering. The recovery seems to be continuing and healthy, and therefore the 5.2% projection. But it does seem that its recovery is not strong enough to overturn the global recession or to put the country immune to that, to the effects. And as a result, perhaps you're seeing exports weaken, industrial production is weakening, manufacturing is weakening, but consumption, services, they're all quite healthy. So there are two things that are happening right now. And in terms of views on the country, you really can't put one word or one description to it. This is a time for differentiation. This is a time to look into the sectors and look into the firms and say which sectors are doing better and which firms are doing better. So for our part, our outlook on sectors that are having to do with consumption, services tend to be more positive. For sectors that are dealing with perhaps continued weakness, for example, real estate, is less so. But overall, the country is recovering, and we expect that to continue into the second half of the year. Back to you.
Thanks, Charles. So I mentioned earlier, this whole private equity credit asset class has been growing by leaps and bounds. And in China, I think, if you look at the China market, you've got pressure on banks to clean up their own balance sheet. You've got lots of companies that are probably in need of financing. So from a, enterprise point of view in China, there's probably a lot of demand for private credit, lenders that are not the normal type of, banking institutions and so forth. So that's from that perspective. But I think the other side of it is really what's in it for, you mentioned some of the transparency, the issues about, whether or not you're getting good information from your companies if you were to lend to them. Because again, the market being potentially large everywhere, there was a survey, I think, that I wanted to mention that BlackRock had done about this whole market. And this survey was just released in this April, the BlackRock Private Market Survey. And in about 68% of the institutions surveyed, and there were about 200 institutions that were surveyed, they plan to increase their allocations in private credit. So I'm just wondering, for a global asset manager like BlackRock, do you see opportunities in China in the private credit space?
Absolutely. Thank you, Eugenie. Hopefully those data points are helpful. In China, there are various opportunities that we are currently seeing in the private credit space, driven by the following factors. First of all, borrowers finding difficulties to access the proper form of capital onshore in China. Second, companies in need for tailored capital solutions. Everything is bespoke, tends to be bespoke in the private credit space. And third, execution and process-driven circumstances. China's onshore credit market is over $12 trillion by some measures, and private credit is just a tiny sliver of that. The onshore credit market predominantly comprises bank loans and bonds that tend to be more standardized in terms of product design and also underwriting approaches. In addition, China nowadays is the second largest economy by GDP and the single largest market bloc across Asia Pacific. That position will stay the same in the near to medium term, and hopefully in the longer term, that position will expand further. In contrast to that, in terms of market potential and white spaces, currently the participation by international institutional investors is still in its very nascent stage. So the first reason driving the private credit opportunity set in China is actually the uneven access to capital. In recent months, I think a lot of market participants are tracking this data in terms of total social financing in China, which is a measure of the total credit available in China onshore, which is also at the same time a key gauge in terms of liquidity that is available in the system. Since late last year, this figure actually stands at around 2.8 trillion RMB, which is a very high level. And by the way, that number is on a rolling 12-month basis. That being said, access to that incremental capital has been uneven. Private businesses and entrepreneurs seeking liquidity may only occasionally get a bank loan that they needed from the commercial bankers. In particular, borrowers with limited hard assets, say for example real estate, tend to find it much harder to borrow under the current environment. One example that we recently seen on the ground in China is a consumer product company that runs several hundred million in terms of top-line business. And in terms of EBITDA, they actually run a portable business. That being said, the only credit instrument that they could access from the commercial banking channel is a is a term loan facility that was secured against its manufacturing plant, which arguably only has several million in terms of asset value. So I would say in the current market, there's still a number of high quality borrowers on the ground in China, yet the access to this liquidity was highly uneven. Next, the demand for tailored capital solutions has never been strong in China these days. That drove demand for lenders who have the right sector and product expertise. There are several factors behind this. For example, for sector-specific reasons, certain companies that do not fall under the traditional underwriting criteria for commercial banks. For example, software or enterprise service companies with very strong contractual and recurring revenue stream from blue chip clients. These companies are actually finding it very difficult to borrow from the traditional channels. This is a typical problem in China because these companies tend to be asset light in terms of the nature of the business. And this is a typical segment where BlackRock likes to step in because on the West Coast, we have a lot of colleagues underwriting this type of software businesses on a full-time basis. So there's a lot of underwriting expertise that we can tap from other pockets of the organization. Secondly, for product design reasons, flexible features that cater to the needs of borrowers under these current difficult circumstances are highly sought after. These features include cash to PIK interest toggle, covenant toggle, and so on. I think we're still in the early innings of this economic recovery. And if you own a business, you probably want to preserve as much cash as possible on your balance sheet. Unfortunately, these are some of the features that are typically not available in the typical bank loan products. In addition to capital availability, private credit addresses other pain points on the borrower side as well. For example, private debt offers additional peace of mind when companies need funding certainty. In an M&A context, the least preferred bid any seller want to see is an offer letter to come with a financing condition. This problem arises when bidders are not 100% certain whether the bank syndicate can work. And we are seeing more of these cases recently, not only onshore in China, but also across Asia. And similar problem can occur for risk financing exercises as well. Our team, compared to that, the certainty of funding is never a problem on the private credit side. Our team in Asia, actually earlier this year, we single-handedly provided 140, 150 million on a single transaction because the borrower needed execution and funding certainty. And with that, in terms of our return level, we actually got an enhancement, and the borrower was very happy to pay that additional return to us as well because we make sure the job is done on the side. And here at BlackRock, in China and across the region, we have team members on the ground in every key market to try to understand the true need from these borrowers from different regions. So to summarize, I think the market size in China is too large to ignore, and the uneven access to capital actually opens a very interesting seam for private lenders like ourselves to serve the underserved borrowers on the ground. Back to you.
Simon, I couldn't help asking you, what kind of return are we talking about for private credit? Are we talking about double-digit return?
I would say generally return level does get to the double-digit level thanks to the base rate, which is now in the 5% handle.
Fantastic. Well, we might come back to this very interesting topic later if we have time, but I didn't want to forget about another major asset class, and that's real estate. Now, we've read a lot about the depressed real estate market in China. I think I'd like to turn to Charles a little bit to talk about just generally what he thinks about real estate. But of course, real estate is something that is tied in, particularly in recent years, to distressed debt and so forth, which is where Avery's going to come in. But anyway, I'm going to ask Charles to briefly talk about generally the property market in China and whether or not there is some, reason for investing into, property, but really more later for Avery to elaborate on the other side of it, which is all this distressed debt that we hear about, which is dominated by the property sector. So, Charles, thanks.
So for the property market, I'll just allude to some of my earlier remarks, which is that there is I think, a perception issue with respect to China overall, and this affects real estate as well. So there are folks who are somewhat disappointed that China is not growing at 8+% anymore, and there are folks who are disappointed that China's hyper growth in its real estate market is not coming back. And that's kind of where we are. The real estate market, if you look at since the start of the private sector real estate market to now, it went through a process of maturation. A lot of the demand for upgrades, a lot of the demand that were previously pent up had been kind of fulfilled in this period. And as such, you've seen growth rates in the real estate market slow down over the last 10 years, really, not just recently. Now, the recent fall that we saw in the last couple of years is something that has been quite alarming for a lot of investors and a lot of developers who perhaps didn't have the right capital structure in this transition, weren't able to make it and ended up defaulting. And this transition is important because in the process of maturing, the Chinese economy's growth is going to slow, and the same thing will happen to the real estate market. The government has made it very clear that it wants to develop the sustainable growth of the sector over the long term, and it's made statements across the government that housing is for living and not for speculation. And as such, a series of policies have come out in the last couple of years that effectively squeezed out a lot of the speculative demand that we've seen in the past that has driven a lot of the growth that we've seen in the past. So we've gotten a lot of questions in the past about what does the market look like on a fundamental basis, right? What if it's just driven by fundamental demand? Nobody was ever really able to put a number to it, but I think that's what we're seeing now. A lot of the speculative demand is out of the market, and now is driven much more by a fundamental type of demand, which has to do with new family formations and population growth and so forth. As such, we think that this process is still ongoing. For this year, we expect home sales to drop about 3 to 5%. Now, this is much less than 26% or so last year, but 3 to 5% is already a lesser decline compared to our previous forecast at the beginning of this year, which is a 5 to 8% fall. So the market is still going through adjustment, but this is perhaps something that the government is aware of and has pursued policies in order to help the sector go on a more sustainable path. And I'll pass it to Avery now, who can talk a bit more about the asset level.
Sure.
Avery, please.
Okay, sure. So I think on the private spectrum of private credit at AB CarVal, our focus is very much toward the sort of the far end of the just often mostly distressed credit. And certainly sitting in Hong Kong, you don't have to look very far to find very distressed opportunities. The Hong Kong, the listed the property developers here, many of them have high yield bonds that are trading, way at deep discounts to par. Some even in the single digits and stuff. So there's certainly, we think there's certainly going to be some opportunities in there. However, the deep subordination of these bonds makes them, not for the faint-hearted. And so at AB CarVal, we actually prefer the investments onshore, where we're able to invest at much more senior levels of the capital structures and with what we think are much more predictable returns. So that really means non-performing loans for us. So I'd like to just talk a little bit about what I see as two sort of positive things about the NPL market in China and one negative. The two positives is that I think with a bit of work you can put together a very good infrastructure to invest onshore in non-performing loans. For us, that means we have a great partner. We co-invest in our deals with a company called Shanghai Wenshen, who is, we think, the leading private NPL investor in China. And they co-invest with us on all of our deals, which is a big advantage. And I would say the regulators have also helped us put in place an access vehicle whereby we can bring capital in and out of the market in a very efficient way and also do all of our litigation from onshore entities in China, which is very helpful. Regarding litigation, that's really my second point, which I think is a positive, is that China is ruled by the rule of law. We're finding with our NPLs, we're obviously resolving disputes every day. We're in the courts every day. And what we're finding is that the courts work. China has a rule of law. It does have rules that are set up to protect borrowers. We're typically the lender in cases where we're inheriting a loan and we're pressing a claim. And in terms of obtaining judgments or enforcing collateral, there are procedural rules to prevent abuses by lenders taking advantage of borrowers, for example, settling collateral at too low a value, essentially stealing collateral from the borrower or the other creditors. So the courts have rules that they have to follow, and as you can imagine, smart borrowers are good at trying to delay processes by using those rules. However, you can delay processes, but you typically can't delay them forever. You eventually will face a reckoning where courts will provide judgments and will enforce collateral. So we think the important thing is to go into the situation with a knowledge about how powerful your borrower is, how important the collateral is to them, how important the collateral is to the local government, and then have proper expectations about what kind of process you're going to follow in terms of pursuing your claim. But all in all, we think it's a positive story. We think that the courts generally work in China. Moving to the challenges, I would say the biggest challenge is the lack of supply in the market. What you have, especially as China faces a slowing economy, they've been very concerned that they don't want credit growth to slow dramatically. And in these periods, China tends to give the banks and the trust companies a bit of a pass in terms of recognizing and disposing of non-performing loans. And so you have, especially after COVID, you have a great deal of non-performing loans that are sitting on the bank's balance sheets, the AMC's balance sheets, and the trust company's balance sheets. And much of it is overvalued. We've seen a slowdown in our collection results since COVID, which is to be expected. And with any slowdown in collections, the non-performing loan value will go down. The banks are typically unable to recognize the full extent of the losses that they're facing in the non-performing loan books, and the same goes for the AMCs and the trust companies. So just for a way of comparison, we're very active in the U.S. and we buy bank assets all the time in the U.S. And what we're seeing there is regional banks will face, as some of them have lost deposits, they're facing pressure from a regulatory standpoint on their loan to deposit ratios. Their deposits are shrinking, and thus they need to sell loans. And so what you find is the U.S. bank essentially is given no leeway from regulators and has to sell the loans, needs to find a credible counterparty, and AB CarVal can step in and buy performing loans at below par in the U.S. By comparison, in China, just this morning, a AMC approached us and said, we have a non-performing loan. It has great collateral. It has not been performing for 2 years, so there's a big chunk of accrued interest that you could collect, but we haven't been able to collect it. We'd like to sell it to you. We'll sell it to you at par. You can collect the accrued interest if you can see it through, but you'll have to pay us par, and we're not allowed to sell it to you at anything less. So as a global fund, where we can choose where to allocate capital around the world, we have in the U.S. performing loans that we can buy below par, and in China we have a seller that is saying it's a non-performing loan, but we need you to pay par for that. So in these circumstances, it's really difficult for us to allocate the capital to China. So that's really the greatest challenge that we face in China. However, we think regulators recognize the problem. We know that banks tying up capital in these unproductive assets is inefficient. The AMCs have largely been downgraded. They will probably have to be recapitalized, and the trust companies are just starting to work on their non-performing loan issues. So we're optimistic, but in today's market, we are finding the supply to be challenging.
Avery, thank you for that. I hope the regulators who are listening in this from China would take some, lessons from all this in terms of, the competitiveness. I mean, particularly for global institutions or asset managers, they have a choice of investing in different markets, and they're really there for the return. So I think to be practical, especially in China where you have banks with a lot of non-performing loans, I mean, the way to get rid of it is that you sell it at below par or a discount to firms that are willing to, sort of deal with these sorts of assets, right? So anyway, I hope the message or what you've just said, Avery, gets to the right people in China.
Yeah, well, we're excited. We've also been granted a private fund manager license, and we're hoping to be allowed to launch non-performing loan funds, because to bring renminbi institutional capital to an area that China really needs new capital to inflow to is we think very good for the country, and having professional managers assist the institutional investors invest in what can be a tricky area, we think is important. So that's an area of growth we hope we'll see in the future.
Thank you, Avery. I want to go back to both Charles and Simon. I mean, in the private credit space, obviously it's growing in many, many markets. It's starting to grow in a big way. And I think Singapore, for example, I did read that MAS is massively promoting this by citing the number of private credit funds that have been launched there. I mean, for China, do you have any suggestions for the regulators or policymakers in China to really, again, utilize private credit, the interests of investors in this area, to help China's, enterprises, especially the small and mid-sized ones, to seek financing other than through the traditional commercial banking channels, which seems to be not fulfilling the demand onshore. So I'll turn it to you guys to see if you want to say anything about what the government can do.
Well, I would say I'm not in the best position to advise the government, but hopefully we can, like in terms of doing our job to help trickle down the capital that is required or needed by some of the enterprises, especially in the SME sectors, would help sort of drive the recovery as part of this ongoing process in China. So we'll do our job and make sure those who need the capital and who sort of check all the boxes on the underwriting criteria get the money that they need.
Charles?
So I would just echo that point. I think policymakers are aware of access issues for small and medium-sized enterprises with respect to the banks or with respect to the capital markets, and part of the reason why this sector is growing is that need is substantial. So if there are healthy and robust companies who are unable to access bank funding or unable to access the bond market, the regulator could perhaps take a look at that and think about what could be done. And I think the government is looking at that. Indeed, there are bond market reforms that are ongoing, and that would perhaps take some time to be rolled out, but it is ongoing. For the markets part, I would just encourage people to think about the transparency issue, think about the credit risk that is being undertaken, because at the end of the day, some of these issuers or some of these companies are going to the private credit market, perhaps because they are unable to access the traditional bank or the capital markets routes. And if that's the case, in some cases, perhaps there's a greater implied credit risk and liquidity risk behind those transactions. So transparency, I think, is what investors should think about, how to deal with these and get their arms around these risks. And the more of that, the better. And the government, to the extent that they could improve transparency in the sector, that would be helpful, I'm sure, for all investors.
Thank you, Charles. And I definitely want to give Jun a final opportunity to say anything before we close this session, because I think we're about out of time. But please, if you want to add anything.
Yeah, I saw a lot of headline news talking about the US dollar fundraising in China down, as you said, between 30 to 80%. But as I said, the majority, the lion's share of the fundraising for China is actually in renminbi. So it's not going to move the needle. So I would suggest, if you are global investors, you should try to not to follow the trend, right? You should follow the business principles.
Okay, thank you very much to my panelists. I'm sure you found it very, very enlightening. Thank you very much for sticking with us until the end. Thank you, gentlemen, for joining this panel. Thank you to the audience.
Great, thank you very much. Thank you very much, Eugenie, and our esteemed panelists.